Today, we're diving into the dramatic story of Wall Street's most iconic players, the investment banks. It's a heck of a tale, really. It shows how the simple act of raising money for companies built a financial empire, triggered a global crisis, and ended up completely reshaping the world we live in. Because, everything we thought we knew just imploded in 2008. That financial crisis wasn't just some dip in the market. No, it was like a meteor strike for the old guard of Wall Street. So what really happened to those legendary firms? To get it, we first have to understand what they actually did.
So let's start at the beginning. Before all the drama, before the movies and the headlines, what is an investment bank at its most basic level? What is its whole reason for being?
At its absolute core, an investment bank is a kind of financial matchmaker. So think of it this way. A company wants to build a huge new factory, or maybe a city needs to fund a new bridge. They need a ton of cash. The investment bank is the specialist they call to go out and raise that money by creating and selling securities, stocks and bonds, to investors. This is a totally different world from your local bank down the street that just takes deposits and hands out loans.
So how's it done? Well, it's basically a three-step process. First up is origination, which is all the paperwork and prep work to get the security ready for sale. Then comes the really nerve-wracking part, underwriting. This is where the bank puts its money where its mouth is. They buy the entire stock or bond issue from the company at a set price. They're on the hook now. Finally, there's distribution, getting out there and selling those securities. And that risk is no joke. Back in 1979, the market suddenly shifted, and the underwriters on an IBM bond deal got stuck with a massive loss. It's a high-stakes game for sure.
Now, you have to understand that these banks operate in two totally different arenas. You've got the primary market. That's where brand new securities are born. Think of a company's big debut, its IPO. But once those stocks and bonds are out in the wild, they get traded on the secondary market, like the New York Stock Exchange. This market for used securities is absolutely critical. It provides liquidity, which is just a fancy way of saying it gives investors the confidence that they can actually sell what they just bought.
For decades, though, there was a strict, unbreachable rule that governed these two worlds of banking. And this rule, this wall, was born from the ashes of the biggest economic catastrophe in modern history.
Just try to get your head around this number. During the Great Depression, more than 9,000 commercial banks in the U.S. failed. 9,000. Public confidence was completely shattered. The government came to a stark conclusion. Banks had gotten way too reckless, mixing safe, boring commercial banking with the high-risk casino of investment banking.
So you can see the chain of events here, right? The 1929 market crash lights the fuse, the Great Depression burns through the whole system, and in response, Congress had to do something drastic. That something was the Glass-Steagall Act of 1933.
The law's central idea was actually pretty simple, but it was incredibly powerful. It built a wall. On one side, you had commercial banking, taking people's deposits, making loans, the stuff that was supposed to be safe. On the other side was investment banking, underwriting securities, which was seen as inherently risky. You had to pick a side. You could not be both, period.
And the whole point of this wall was really threefold. First, stop banks from gambling with their depositors' money. Second, prevent all sorts of conflicts of interest. And third, and maybe most importantly, restore the public's faith that their life savings were actually safe in a bank.
But you know how it is with walls. This one eventually started to face a lot of pressure. By the end of the 20th century, the financial world was changing fast, and that old wall began to look, well, a little shaky.
It didn't happen overnight. It was more like a slow erosion. Starting in the 80s, regulators began to find creative ways to reinterpret the rules. They let commercial banks dip their toes back into the investment game as long as it wasn't their quote-unquote principal business. The lines were definitely starting to blur.
And then boom, in 1999, the Gramm-Leach-Bliley Act came along and just sledgehammered the rest of the wall into dust. It created this new kind of monster, the financial holding company. All of a sudden, a commercial bank, an investment firm, and an insurance company could all live under one gigantic corporate roof. We're talking about financial supermarkets so massive they would soon be called too big to fail. After 66 years, the separation was officially over.
So this new all-in-one financial supermarket was about to face the ultimate test. And what came next was a meltdown that nearly brought the entire global economy to its knees.
The crisis that really blew up in 2007 and 2008, well, it spelled the end of the line for the independent investment bank as we knew it. Their whole business model, which was fueled by a ton of debt and dangerously exposed to the collapsing housing market, it just completely broke. I mean, look at this. At the beginning of 2008, you had 5 titans dominating this world. Within a year, their universe ceased to exist. Bear Stearns was sold in a fire sale to J.P. Morgan. Lehman Brothers filed for the biggest bankruptcy in U.S. history. Merrill Lynch was forced into the arms of Bank of America. And the last 2 left standing, Goldman Sachs and Morgan Stanley, had to race to become bank holding companies, totally abandoning their old model just to survive.
This headline from back then just says it all, doesn't it? Where, oh where, have all the investment banks gone? In the blink of an eye, an entire category of Wall Street powerhouses had basically vanished. They were either bankrupt, bought out, or forced to become something completely new and much more regulated. And then there were none.
So, with the old investment banking model shattered, a power vacuum was created. And as we know, nature and finance abhors a vacuum. New powers started to rise and fill that void. And that brings us to the incredibly powerful world of private equity.
Private equity has become this massive force, and they play a totally different game. These firms go out and raise huge pools of money from investors to buy companies directly, taking them away from the public stock markets.
And this world really has 2 main flavors. On one side, you have venture capital. Think of them as talent scouts, placing early bets on small, fast-growing businesses, hoping to find the next big thing. On the other side, you have buyout firms. They go after bigger, more established companies, often using a strategy called a leveraged buyout, or LBO. Basically, they use a ton of borrowed money to buy a company, hoping to restructure it and sell it for a huge profit.
You know, from the high-wire act of underwriting in the old days to the massive leverage buyouts of today, one thing hasn't changed a bit. This quote just nails the timeless DNA of high finance. It is, and it will always be, about one fundamental trade-off: huge risk and the potential for huge rewards.
And that really brings us to today. The wall of Glass-Steagall is a distant memory. The great titans of independent investment banking are basically history. And in their place, a whole new financial order has emerged, which leaves us all with a pretty critical question. In this completely reshaped world, who really holds the power? And who is writing the rules for the future?